Okay, this method is going to be the aging of accounts receivable, so it's a little bit different than the allowance method that we did prior. So we're going to go through these one step at a time, and we had beginning balances, which are the same thing as the ending balances of last year, for accounts receivable of $60,000, and then we had in allowance for bad debts we had $2,000. So we sold on credit $80,000 worth of merchandise for the year. We collected $74,300, and we wrote off the uncollectible accounts. Remember, these are all the individual accounts that we've determined are way too old. These specific people are not going to pay, and we're writing off those particular accounts receivable. Remember, that has absolutely nothing to do with the bad debt expense that you're going to record. Okay, so we're going to journalize those transactions, post them to T accounts, record the bad debt expense, and then we're going to show you what the balance sheet would look like. Okay, so first things first, we're going to record those credit sales. So we're going to debit accounts receivable for $80,000 and credit sales revenue. So this is day one basic accounting stuff. We're going to ignore cost of goods sold. Next, we said we collected $74,300. So that would be our debit to cash for those collections, and we're going to reduce our accounts receivables by that much. So $74,300 credit to accounts receivables. Next, these are the specific accounts we're going to write off that we've determined are too old. So how do you get rid of an accounts receivable if it's a debit? Well, you credit it. So we're going to credit accounts receivable for $2,700, and the offset is going to go to allowance for bad debts. Okay, next what we're going to do is we're going to show using the aging method, not the allowance method, of how we're going to record the bad debts here. Now, when you hear the word aging, what I want you to think of is target. Okay, if I tell you an aging of accounts receivable indicates $2,200, when you hear that, you think, okay, my target or my ending balance needs to be $2,200. $2,200 is not what you journalize for bad debt expense. It has to be the ending balance in the account. So it's going to be your final answer in your T account, and that'll be the amount that shows on your balance sheet, but it is not the amount you journalize for bad debt expense. So you're thinking, well, how do I determine that? Well, you throw it in a T account and you analyze it and you see how it shakes out. So we know that the allowance for bad debt had a beginning balance of $2,000, and we know we wrote off $2,700. And the aging method, the aging of the accounts receivable, tells us that $2,200 has to be our ending balance. So it has to be the final answer, but that doesn't balance. So we need something right here to make that balance. So if we start off with $2,000, you can do this in an algebra equation. What you would do is you would say $2,000 minus $2,700 plus what, or plus X, equals $2,200. And when you do that, the math ends up with a $2,200 credit, and that's going to be your bad debt entry that we'll do in just a second. But that's how that analysis of that T account works. You have to have $2,900 here for that to balance. So if you want to check it, you do $2,000 plus $2,900 minus $2,700 will give you $2,200 as the ending balance. Now this is what's going on in your accounts receivable. You started off with $60,000, then you made credit sales of $80,000. You collected $74,300, and you wrote off $2,700. So what's sitting in your accounts receivable as an ending balance is $63,000. Now this is how you would do the entry, okay, for that allowance. Remember I told you the number that you found, the number that you solved for and plugged was the $2,900. Remember I told you that was going to be your journal entry. So you're going to debit your bad debt expense here for $2,900, and your allowance for bad debts is going to be your credit for $2,900. Now what this aging of accounts receivables means is they put things into categories, and they say, okay, if it's 0 to 30 days old, we're going to determine that 95% of that's going to be collected. Because it's fairly new and it's fresh, and most people that fit into that category, it's not a very old accounts receivable, most of those people are going to pay. Now if it's between 31 and 60 days old, it's a little older, so they've gone almost 2 months here and not made a payment, then we determine that a little bit less of that will be collected. So maybe 75% of that will be collected. Now if it's between 61 and 90 days, it's gotten really old and they haven't made a payment, they haven't attempted, so maybe only 50% of those that fall into that age category will be collected. So that's what they're saying, is they've done an analysis, and the aging of accounts receivable, after you do all the math on all those individual columns, they determined that the ending balance should be $2,200, and that's where we did the T account and forced that number and ended up with the $2,900. So that's what aging of accounts receivables means. Okay, now here's what your balance sheet would look like. You start out with your accounts receivable, which was $63,000 ending balance, and then you net the allowance for bad debts. Remember, it's that contra asset account. It goes against the asset accounts receivable, and its ending balance was $2,200. So your ending answer there would be the net of the two, $68,800, and that's your aging of accounts receivable.